The broadcast is now starting. All attendees are in listen-only mode.
Welcome to our 2019 webinar series. Our 2019 monthly webinars will include client stories, your client stories, and how those stories can help you and your clients in this year and beyond. Each webinar will last about 15 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer all questions at the end of the webinar. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. Today's presenter started working at LLIS in 1998. Since then, she's become LLIS's go-to person for connecting your clients with long-term care insurance solutions that meet their needs. And here is Jill McNeil.
Thank you, Claudia. Good afternoon, everybody, and thank you for joining us today for our webinar. Today we're going to talk about long-term care and some concerns around that. So let's get started. It's important that you talk to your clients about planning for the future and what would happen if they did experience a long-term care need, because 70% of people over the age of 65 will need long-term care services sometime in their lifetime. And 74% of those people prefer to receive their long-term care services at home. They'd rather stay in their home than go to a facility. And it's estimated that by the year of 2024, there'll be 120 million people will need home health care services. But the problem is there is a 70% turnover rate for home health care workers. So what is causing that turnover rate? Well, there's several factors, but a couple of them that we believe are leading to that are the low unemployment rates in the U.S., which is causing wage pressures and labor shortages. A couple months ago, I saw there were 7 million jobs available in the U.S., and the majority of these jobs are in healthcare and construction. So I think what's happening, these healthcare providers in the past, they didn't have as many choices in jobs, so they were okay to provide home health care. But now that they have more choices, they could maybe get jobs in hospitals or doctor's office. They don't want to do the home health care job, so there is a shortage. So people that have not planned for the future and then all of a sudden they need care, it's a little more expensive for them to find it, or if they are able to find it. And another reason for the shortages, I believe, is because we have improvements in our medical care. So doctors are helping people live longer, maybe curing them from cancer or heart attacks or heart disease. And people are living longer, but maybe not have the quality of life that they want, or then they need care in their homes. So since there is a shortage for health care and there is the demand for home health care workers is going up, and demand for overall long-term care services, people are going to have to turn to informal caregivers. And a lot of people do plan on using informal caregivers. And what do I mean by informal caregivers? Well, an informal caregiver is an unpaid individual, usually a friend, a family member, or a neighbor that provide the care, not somebody that's certified or licensed. 66% of older people receive care at home by a family member, and 58% of those informal caregivers have intensive responsibilities, such as assisting with bathing or feeding. So think of it, if you have a son or a daughter that's taking care of mom and dad, and they have to do those intimate duties like bathing or helping them dress, things like that, it becomes kind of awkward. It's not enjoyable. And what is the impact on these caregivers? Well, its average caregiver provides 24 hours of care per week, and it has an economic impact on them. They have less time to spend at their paid jobs, and maybe they have to give up promotions because they don't have the time to spend extra time at work, or they are not able to travel because they have to be there to take care of mom or dad. And the other issues, it affects the caregiver's health. A lot of stress taking care of somebody, and anger or substance abuse. It's shown that these caregivers tend to abuse alcohol and drugs more often than people that are not caregivers. And 40% of sole caregivers predecease the patient. So when you have a husband and wife, and maybe the wife is taking care of the husband, as I said, it takes a great toll on the wife, and she many times predeceases the husband or the patient. So help your clients look at these factors, and they don't want their families to be their caregivers. Maybe they want their families to manage their care but not provide the care. In 2018, there was $241.7 billion spent on paid care at a home or a facility. That's a huge number, but look at this number. $522 billion. This represents the amount spent on informal. If you were to pay those informal caregivers, also represents the amount lost, those informal caregivers lost by not being at work when they needed to be or giving up on those promotions. So that, just to put things in perspective, that 522 billion is more than the total sales for Walmart in 2016. Walmart's total sales were $482 billion. So that's a lot of money that would have been spent if we were paying informal caregivers. Here's a chart that I came across that I thought would be interesting, just to give you an idea of how costs are increasing for care overall. I'm not going to read all these numbers, but look at that private room in a nursing home. From 2004, the average median cost for a private room in a nursing home across the U.S., $65,185, but by year 2018, it had risen to $100,375. That's a 54% increase. So that's a huge increase. And you can see all the areas are increasing. So this is, as I said, the median cost of care around the country. If your clients live in New England, California, other places, Alaska is the most expensive place to receive care. Care is going to be more expensive than these numbers shown here. So when your clients are looking at the future and trying to decide if they have enough in their own savings to pay for care if they need it, help them to understand that the cost could be much more expensive in their area. So it's important to look at cost of care where your clients are living or they plan to retire. Genworth has a great study that they do every year, cost of care study, that you can locate on the internet, that gives you will help you find cost of care around the country. So before we go any further, let's talk about the elephant in the room. Well, in this case, it's actually an elephant on the screen. And what I mean by that, the elephant in the room, is whenever I talk about long-term care with advisors or clients, many people hesitate or are negative about long-term care because of rate increases. So let's talk about that right away before we get into any more detail about long-term care and address this. So let's start by looking at the history of long-term care. In the late 1970s, the first long-term care policies were introduced. By the late 1980s, these long-term care policies really caught on. They were very popular. So by the late 1990s, there was 100 plus companies offering long-term care policies. But as time went on, the actuaries and the companies realized they did not price these policies correctly. When the long-term care policies came out, they didn't have any claims experience or lapse history to base them on, so they weren't sure how to price them. Well, as I said, in the late 1990s, 2000s, they realized that these policies were priced incorrectly and they were losing money on them. So by 2014, there are less than 15 major long-term care companies still offering policies. But the need is still there for long-term care services because, as I talked about earlier, our population is aging. In the 70s, $20 billion spent in long-term care expenditures. In the 80s, $30 billion in long-term care expenditures. Late 1990s, $225 billion in long-term care expenditures. So the need is going up. So companies, long-term care companies that are still in the long-term care business, we feel they're there because they realize there's a need and they're getting products better priced. They're doing a better job of pricing the products and they're making money on these policies. So what does the future hold? Well, last year, the American Association for Long-Term Care Insurance did a survey and they asked actuaries what they felt about future rate increases. And most of the actuaries responded saying they see little to no risk of future rate increases on recently priced policies. So we're saying on recently priced policies, so policies that were issued in the last couple of years. And why do the actuaries feel this way? Well, because things have changed since these policies first came out 40 some years ago. They have decades of experiences. The actuaries have a better idea of what claims history is going to be, what lapse rates are going to be. They've sold millions of policies, so they have a better feel of the industry. Hundreds of thousands of claims have happened. And the interest rates went down since these policies were first introduced, so the rates are still current, but interest rates are increasing a little bit, hopefully, maybe, and more standardizations and regulations to the industry. They saw that over time they realized that the insurance companies realized that females go on claim a lot longer than males, and they go on claim a lot more often. So about 5-6 years ago, the insurance companies switched to using, or most of the companies switched to using gender-specific premiums. So that means rates for females are much higher than males. Mass Mutual is one of the last companies to go to gender-specific premiums. They introduced their new product a couple months ago, and I believe it's available in about 36 states. And on that product, the premiums are much higher for females. Some of the states still have the old product, so if you have any clients that are females, in some states, they can still get the Mass Mutual policy with those unisex rates, but they should move fairly quickly because we don't know when the new products can be introduced in those states. And the other changes they made, they did away with a lot of different riders. The companies did away with several different riders. Used to be you had a choice of riders on return of premium, premium payment. You could do a single pay, a 10 pay, pay to age 65. Well, that's no longer the only option on traditional long-term care insurance is just annual premiums. And they did away, one big thing was they did away with unlimited benefit periods. Because how did the insurance companies know, how can you plan for policies that have unlimited benefit periods? You don't know how much they're going to have to pay out in claims over time. So they've done away with that. So overall, with all these changes, we feel the policies are priced better, and we shouldn't see rate increases as often or as high in the future. Back to that study that I talked about, the American Association of LTCi, nearly 80 of the actuaries responded, and 79% of those actuaries said they see only a 10% or less risk that premiums will have to be increased on these new policies going forward. 12.5% predicted the likelihood of future rate increases at 20%. 4.2% predict a likelihood of 30 to 40%, and then another 4.2% said at 50% or more. So hopefully the industry has settled down and we won't see those great increases in the future. Now, I'm sure a lot of your clients that have long-term care policies that they've bought in the past was through Genworth. Genworth used to be the leader in the industry. They have a lot of policies on the books. When I started doing long-term care here at LLIS about 8 or 9 years ago, probably 90% of our sales were with Genworth. But we stopped offering new Genworth policies about 4 or 5 years ago when their financial ratings took the big plummet. So today I get a lot of advisors and clients coming to us asking us if they should still hold on to their Genworth policy, and what is the situation with Genworth. So Genworth has sold off small blocks of business. As a result, they're strengthened their ability to pay claims. They no more offer new life insurance policies, so that has taken a big chunk of their expenses away. They don't have to maintain that new policies, underwriters, or new business departments. Genworth has $1.3 billion in surplus assets, so that means if they had to pay all their liabilities at once, they would still have over $1.3 billion in assets to handle things. And they've improved their quality of investments. Industry average was last year. Industry average a yield of 4.10%, while Genworth earned 4.72%. So they're doing better on their investments. I know Genworth was for sale, and China Oceanwide was in the process of purchasing it, and I apologize, I meant to check today to see if that's finally gone through. We think that when that does go through, China Oceanwide will put more money into Genworth and shore it up, so that should be a good thing for policy holders. But I still get a lot of policy reviews. So here's an actual policy review that came in a couple months ago to us. So these people, Jeff and Val, that's not their real names. I did change their names, but it is a real couple, and this is a real situation. They're both age 75, and they live in South Carolina. And they sent in a quote request, and what they wanted to see was a quote for $280 a day, 6-year benefit period with shared care rider, 5% compound inflation, and 90-day elimination. Well, come to find out, they wanted these benefits because these are the benefits that current Genworth policy has. And the premium on their Genworth policy is $6,056. Well, they had recently received notice that they were going to have a 20% rate increase. So their premium on the Genworth policy was going up to $7,268. So they wanted to know if they should hold on to this policy. What would it cost to replace it with a new policy today? Well, if you were all sitting in front of me and I could see you, I could see your mouth drop, because look at the premium on a new policy today for 2019. Premium with these benefits at their ages, $46,431. So what do you think? Think they should hang on to that current policy? Yes, most definitely. So that's pretty easy. I mean, that policy I think was about 20 years old. So that's, pretty self-evident, or pretty evident when a policy that old. So here's another one that was pretty close to me, another rate increase on a Genworth policy. This is my own Genworth policy that my husband and I purchased back in 2012. We bought a small policy, $125 a day daily benefit, 2 years of shared care, 3% compound, 90-day elimination period. Policy had a premium of $1,370. Again, a small policy. At the time, our daughters were in college. We had some other expenses, but we wanted to get something in force while we were still young, and rates were pretty reasonable. So we purchased the policy. Well, 2015, we had our first rate increase, 23%. So premium was going up to $1,684. Well, 2018 received notice from Genworth that we were going to have a 25.6% rate increase, and they told us that we were going to, over the next 3 years, we were going to have rate increases of 25.6%. So by the end of 2020, our premium would be $3,337. So over this period of time, I was going to have 98% rate increase. So I ran some quotes to see what a new policy would cost us today with these benefits. Now, benefits are growing because we have 3% compound inflation, but a new policy today. Oh, I forgot to mention that with those rate increases, Genworth promised us that we would not have any more rate increases until the year 2028. So after 2020, no rate increases for 8 years. But again, so what would a new policy cost us today? New policy premium $4,225. So even with 98% rate increases, a new policy today would still be about $900 more than I'm paying now. So we hold on to this policy because we realize it's still a good deal. And what are other reasons we hold on to this policy? Well, I keep this policy because we've purchased it for ourselves, but for our daughters. We do not want our daughters to be our caregivers. We want them to be able to manage our care if it ever needs to get to that point. I don't want them to have to put their lives on hold to take care of my husband and I. So stress this to your clients that when they are planning for the future, purchasing a long-term care policy, even if they don't purchase a long-term care policy or a hybrid, help them to understand that whatever planning they do is for a gift for their family members. It's not just for them, it's for the whole family. So let's switch gears here a little bit and talk about policy design. Lots of times I have advisors and clients come to us and they realize that they really should look at purchasing a long-term care policy, but what benefits should they have, or what's the starting point? So this is what I kind of call our LLIS special. And the steps here are just initial steps. They're just to sort of get the ball rolling, get your clients an idea of what premiums are. So this is not a hard and fast rule, but again, these are the steps that we follow when clients aren't sure what they need. We start by looking at cost of care in the area. And so since I'm here in Tampa, looked at cost of care in Tampa, $317 a day is the median cost for a private room in a nursing home in Tampa area. At LLIS, we use what we call the 80% rule. We recommend that clients cover about 80% of that cost because your clients already have in their budget to pay for food and some other minor essentials, but about 80% is what nursing home would cost them out of pocket. So I'd recommend a $250 daily policy or benefit for if I were to buy a policy today here in Tampa, I'd start by looking at $250 daily benefit. Elimination period, 90-day elimination period. This is kind of the sweet spot on these policies. You can get a lower elimination period, a shorter elimination period, but it's going to be more expensive, or you can get a longer elimination period, and I'll get into more detail on that. The 90-day, many advisors recommend their clients have a 3-month emergency fund, so with that they could handle 3 months of care. And the 90 days also coordinates well with Medicare. If your clients are fortunate enough, if they go on claim to receive benefits through Medicare, that will only last for 100 days. And Medicare will only pay 100 days if the person has been in a hospital for 3 days or more, and when they're released they need skilled care. Medicare will pay 100% for the first 20 days, and at day 21 to day 100 they'd have to pay a copay. So if your client have a long-term care policy with a 90-day elimination, they can start that right away, so they're satisfying their elimination period while they're receiving benefits through Medicare. And for couples, we recommend 3-year benefit periods each with a shared care rider so they can share their coverage. And I'll get into the shared care a little bit later on some other slides. And 3% compound inflation. By adding 3% compound inflation on, the benefit grows by 3% every year. Cost of care has been rising about 3 to 5% across the country in the different areas of care. You can still get 5% compound inflation on policies and 4%, but it's become so expensive that most people go with a 3%. So a policy with these benefits would have an annual premium of $8,727. That's for a 55-year-old female and a 62-year-old male. That's the premium. So that's, again, a starting point, but maybe if your clients look at that premium and say, well, okay, maybe we don't need to go with that high a policy. How can we scale down the benefits and save money on the premium and still have a decent policy? Well, then we'd look at all the cost of care in their area. So in Tampa, assisted living, $107 a day. Home health care, $135 a day. That's based on 44 hours of care per week. The nursing home costs we talked about, $317, semi-private, $274. Well, if your clients have a fair amount of assets that they know they could supplement if they need care, maybe they want to put 50% risk on the insurance companies. So they know that if worst case scenario, if they needed to go into a nursing home, they would have to put up about 50% of their costs. So in this case, I'd recommend your clients consider a daily benefit of $150. With a $150 benefit, they know they'd have assisted living covered and home health care covered. But again, if worst case scenario, they had to go into a nursing home, they have enough in their own assets that they could cover the balance. Recommend going down to a 2-year benefit period with a shared care rider so they can share their coverage. They have about 4 years to share between them. Not the longest coverage, but it would cover most claims. 90-day elimination and keep that 3% compound inflation. So if they reduce the benefits by this much, new premium $4,225. So that's a savings of $4,500 over that last policy that I saw where the daily benefit was higher and we had the 3 years. So still a good policy, would cover 100% of assisted living, home health care, and 50% of nursing home, or a little more than 50% of nursing home. So a good policy. How else can you scale down the policy? Well, 3% compound inflation rider that I had on this policy was for lifetime. So that means the benefit would grow 3% every year for the lifetime of the policy. Okay. Well, there is another option to go with a 3% compound inflation for 20 years. So that means after 20 years, the inflation stops and the benefit stops. So if your clients are in their 60s, 20 years, they're in their 80s, they're maybe close to being on claim. So having the policy continue to grow is not quite as crucial as it is for when they're younger. If your clients are in their 50s, they may not want to go with this option, but I just thought I'd show it to you. But by going to this 20-year inflation option, the premium goes down to $3,779. And over 20 years, saving that amount, saving $446 a year, And by 20 years, they would have saved $8,900. So a nice savings. What else could we do? Well, a lot of times people ask, what if we increase that elimination period? What if we went to a 180-day elimination period instead of the 90? Well, if you do that, the premium goes to $3,489. It's only a savings of $290, which it's decent, but it's not great. If you think about if client went on claim and had to pay out of pocket for another 90 days, they're going to have to spend a lot more out of pocket when they go on claim than they would by just saving $290 a day. So I recommend they stay with that 90-day elimination period. Now let's talk about some of the basics of long-term care. As I said, I've been doing this for several years, so I tend to catch myself thinking, well, everybody knows what I'm talking about when I talk about different features of long-term care. But then I have to step back and realize, no, not everybody understands all the basics of long-term care, because people really don't look at it until it comes time to look at a policy for themselves. So let's talk about some of these basics. Many times when I show clients a policy, they see a 3-year benefit period and they're like, well, what happens after 3 years? Is it over after 3 years? They don't understand that really long-term care you should think about as a pool of benefits. So you start with your pool of benefits. And what do I mean by that? Or how's that pool of benefits achieved? Well, if your client has a $200 a day daily benefit and they have a 3-year benefit period, the pool of benefits is calculated by taking that $200, multiplying it by $365, or I'm sorry, 365 days in the year times 3 years, because they have a 3-year benefit period. So they have a starting pool of $219,000. Okay, and I'm just talking about a basic without inflation. They have a starting pool of $219,000. The least amount of time that policy lasts is 3 years. So if they went on claim and used $200 a day for 365 days a year for 3 years, they would have exhausted that pool of benefits. So if they use the maximum amount of benefits every day, that pool is going to be exhausted. Excuse me. So that's the minimum amount of time that policy will last. But let's say they only use $100 a day. Then that pool would last twice as long, so it would last for 6 years. So help your clients understand it's really a pool of benefits they're going through, they're working with. It's not just that time period. Okay. And if your clients have a shared care policy and they each have 3 years, it could last for 12 years. It just, again, depends on how quickly they go through the benefits. You can't use more than your daily or monthly benefit, but you can use less. And all policies nowadays are reimbursement. So what this means is if they go on claim, satisfy the elimination period, they have to pay for their care. But then at the end of the month, they'd submit invoices to the insurance company. The insurance company would reimburse them up to their daily or monthly benefit period. So no basic policies anymore for traditional long-term care are indemnity. But Mutual of Omaha and Transamerica have what they call a cash benefit. So a cash benefit is kind of like a little indemnity policy within these policies. So the cash benefit is equal to 30% of the monthly benefit. So that means if your client's on claim, they can contact the insurance company and say, hey, I'd like to receive my cash benefit this month. The insurance company will send them a check equal to 30% of their monthly benefit, and they can use that check to do whatever they want, to spend however they want. Maybe they want to pay a family member that month to take care of them, because nowadays with these newer policies, any care, home health care has to be provided by a certified or a licensed caregiver. So, but in this case, if they have the cash benefit, they could use that check to pay a family member or one of those informal caregivers to provide their care. If they receive their cash benefit in the month, they do not have access to the other 70% of their benefit that month. But that 70% doesn't go away. It just stays in the pool of benefits to be used later. So again, this is an example of how the policy could last longer. Okay, so again, that cash benefit is kind of like a small indemnity policy. Now let's talk about the shared care rider a little bit more. Shared care rider is a rider that we highly recommend for couples to add on to their policies. We don't recommend many riders, but the shared care is, we feel, worth the extra money. So it allows the couples to share their benefits. So here we have Sean and Katie, and we're saying that they each have a policy, and we're saying they're same ages. And here I just want to point out the reason for the difference in premiums. Remember earlier I talked about gender-specific premiums? Well, see, Sean's premium, $1,954. Katie's premium, $3,152. And again, the reason for that is because Katie's a female, and with the gender-specific rates are much higher for females. Okay, well, let's get back to the shared care. So if they have shared care, they can share their coverage. So for example, if Sean became sick and he went through his whole pool of $219,000 of benefits, he could then tap into Katie's pool of benefits. With Mutual of Omaha, they have to save 1 year each to use themselves if they're both living. So Sean could use 5 years, leaving Katie with 1 year. With Transamerica, they can use all 6 years. So Sean could use all 6 years, leaving Katie with 0. But let's say Sean has used no benefits and he passes away. So then what happens? Well, his benefits are transferred to Katie. So now she's still, and we're saying nobody has used any of their benefits. So we're now saying that Katie has a pool of $438,000 of benefits, and she only has to pay her premium of $3,152. Sean's portion of the premium drops off. So Katie has double the benefits and only has to pay her premium. Because as I had said earlier, females usually go on claim longer and more often. So it's nice when the females have the higher pool, and it could go either way. We just don't know who's going to need more care than the other. So this is nice that more flexibility added to the policy. Now let's talk about elimination periods. So there's 2 types of elimination periods. One very common type is called days of service. So this means only days the proposed or the insured receives care counts as towards their elimination period. So if they're receiving care in their home, and I think that's where it's most important, if they're receiving care in their home and they only receive care 5 days that week, only 5 days counts towards that elimination period. So it could take 18 weeks to satisfy a 90-day elimination period. The other type of elimination period is what we call calendar days. So once they start to receive care, day 1 today, 90 days on the calendar from today is when they would satisfy their elimination period. It doesn't matter how many days they actually received care. So with a calendar day elimination period, it's usually quicker to satisfy and easier to understand and keep track. And you only, with either type of elimination period, you only need to satisfy your elimination period once in a lifetime. So if an insured goes on claim and receives benefits, and then maybe after being on claim for a year, they become healthy again, they go off claim, start to pay their premiums again, and then 2 years down the road, they go on claim again. They do not have to satisfy that elimination period a second time. The other thing about elimination periods, you do not have to satisfy it in one claim period. So if an insured goes on claim and uses 50 days, satisfies 50 days elimination period, becomes well again and goes off claim, and then down the road becomes sick again, he'd only have to satisfy 40 more days because they'd already satisfied 50 days. So only once in your lifetime, it does not have to be consecutive. Here's a calendar I put together just to show the difference, how long it takes to satisfy your elimination period, depending if you have calendar days or days of service. So if you went on claim on February 7th, by May 7th, if you had calendar day elimination, you would satisfy it another whole month later for days of service. Let's talk about inflation. There's still several inflation riders available. There's still the option do not add any type of inflation rider onto a policy. Compound inflation, 1 to 5%, depending on the companies. Most companies for sure have 3 and 5%. Some of the other companies have 1 to 5%. No option anymore for simple inflation. So the inflation rider increases the daily benefit and the benefit pool on each policy anniversary. None of the companies we work with still offer future purchase option. This was an option that if you have this every 2 to 3 years, the insurance company would allow the insured to increase their benefit without having to go through underwriting. And if they accepted the increase, the premiums would go up. But as I said, none of the companies still offer this. This is a question I get a lot of times from clients and advisors. When is a good time to apply for long-term care coverage? Well, 55% of policies are purchased between the ages of 55 and 64. So this is kind of the magic age, or the age most people are starting to think about it. And I think the reason for that is people's focus has changed. In their 30s and 40s, 20s, they were more concerned about building up their assets. But by mid 50s, 60s, they're starting to think about retirement, and they want to make sure that their assets will last. So they start thinking about the future and planning for a long-term care event. Average issue age on long-term care policies is age 55. And then here I just want to show you the difference in premiums if your clients wait to apply. So 8 to 10% higher premiums if a client applies at age 65 rather than age 64. So this is just to give you an idea. There's no, like a lot of people think, oh, I've got to apply before I turn age 60. Well, premiums are higher at age 60 than they are 59, but not a lot higher than they are between 60 and 61 or 58 and 59. They're different. They're higher every year you wait to apply. And if your clients wait to age 69 to apply, a lot of times health has changed. So only 38% that apply qualify at age 69. So when we're in our 50s and 60s, unfortunately, our health probably is never going to get any better. This is the time we start going on high blood pressure medications or cholesterol medications, and unfortunately our body starts to break down a little bit. So always better to apply when you're younger and healthier, so you can qualify and get lower premiums. I've had a question come in that it asks, how do clients report approved elimination days? Well, that's a good question. They would have to show that they were receiving care. So they would have to send invoices to the insurance company to show that they're receiving care. So to satisfy the elimination period, you have to be receiving benefits that would normally be covered in your policy. So in that case, you'd have to be receiving care at home or in a facility. So you could submit the invoices to show that care is being received, and that would satisfy the elimination period. Had another question, said, will slides from this presentation will be available? Yes, they will. You can email me or just let us know, or call tomorrow, and I will make sure you get those slides. Here, let's talk about some case studies that we've had in the office fairly recently. Here's a case, Tom and Susan, again, changed their names, but they came to us several months ago. They're both age 61, and they live in New Jersey. And Tom had a life insurance policy. Again, this is a real situation. Just wanted to show you some options of things that we can do to help your clients. And Tom's life insurance policy had a death benefit of $502,413. It had a cash value of $244,333, and he had a cost basis of $72,962. So that cost basis represents the premiums that he's paid into the policy. And the advisor sent them to us because they needed long-term care coverage now more than they needed that large death benefit. Tom was getting close to the age of retirement. That death benefit was no longer needed because they'd built up their assets. But now they were concerned about long-term care. So they wanted to know, what could we do with that cash value to help them get care? Well, we started looking at options. First, we looked at cost of care in New Jersey to see how much care they might want. So $390 a day, private room for a nursing home in New Jersey. Well, to use that cash value, we cannot do a traditional long-term care policies. I cannot fund a traditional long-term care policy with the cash value. The rules allow it, but I don't have any companies that you can actually do it with. And really can't do it because the long-term care policy, traditional long-term care policies require annual premiums. Can't do a lump sum, so you have to do an annual premium. So companies that we work with will not do it. So the option is, oh, sorry, got ahead of myself here a little bit. What Tom decided he wanted, and when we told Tom about the rules of 1035 exchange, the best option for him is do a hybrid life policy for Tom. So a hybrid life policy is a life insurance policy with a long-term care rider. It's a permanent life insurance policy with a long-term care rider. So for Tom, he wanted a $10,000 monthly benefit on this hybrid policy, 4-year benefit period, 3% compound inflation, and a death benefit of $259,200. So we could do a 1035 exchange, but he wanted to take some money out of this policy first. So, or he wanted to take $42,000 out of the policy, out of the cash value, and then we would 1035 exchange the rest. So what we recommended was he go ahead and apply, get this hybrid policy approved by underwriting, and then before the policy was issued, he would go back to the initial company, take the $42,000 out of his cash value, and the $42,000 is within his cost basis, so he would not be taxed on that. Once he had taken out that $42,000, the insurance company did a 1035 exchange of $202,333 to fund this hybrid life policy for Tom. And this hybrid life policy is for Tom only, because the 1035 exchange rules will not allow us to exchange money into a policy that does not have like owners. So Tom was the original insured and owner of his original policy. So the new policy has to have the same insured and the same owner. So it can be for Tom only. We cannot cover Susan with this hybrid policy. But Tom was happy with this, and we did this, and we were able to get a policy in force for him. But what about Susan? She still needed coverage. So we recommended Susan apply for traditional long-term care. She wanted a daily benefit of $310, 4-year benefit period, 3% compound, and 90-day elimination. Annual premium for Susan, if she applied on her own, $5,627. So good coverage, very similar coverage to what Tom was able to get with the hybrid. But then we had a decision to make. If Susan applied on her own, that would be the annual premium, the $5,627 that I discussed. But if Tom applies with Susan for the traditional long-term care, for the very minimal benefits, they would both qualify for a 30% couples discount. So Tom would have his hybrid policy. Yeah, we'd recommend Tom get that hybrid policy, and he did, but also apply for the long-term care insurance with Susan so that Susan would get that 30% discount. So Tom, minimal benefits, $50 a day, 2-year benefit period, no inflation rider, 180-day elimination period. So by applying together, premium for the two of them, $4,928, a savings of $699. So Susan has her long-term care policy she wants. Tom has a little long-term care policy with some benefits. It saves him $699 because Tom still has that hybrid policy. So Tom has $10,000 a month with the hybrid policy. So doing the other policy for Tom gets him the small benefits, but really the point of doing it was to save him $699 a year. So it worked out, they were both happy. Okay, I have a question here. On the previous slide, what was the 38% qualify at age 69? So on that previous slide, I had said that of people that applied for insurance at age 69, only 38% of them actually qualify. The other 62% don't qualify because their health has changed so much or declined and they cannot qualify. And I have another question here. If Tom needs care, which policy pays first and how is that decided? So, this question is in regards to Tom and Susan. If Tom goes on claim, which policy pays first? Well, the rule is the policy that was put in force first. So he would, in this case, Tom's hybrid life policy was put in force first, so he would file a claim on that hybrid life policy. If the hybrid life doesn't cover all his expenses or his costs, then he would file a claim on this traditional long-term care policy. Here's another case study that we had, underwriting case study. Here, this again is another real case. Jack and Diane, age 66, came to us wanting long-term care insurance in 2016. They want a $5,000 monthly benefit, 90-day elimination, 3 years shared care, and 3% compound inflation rider. Well, during the application interview with our case manager here in the office, it was discovered that Diane would be uninsurable due to osteoarthritis injections she was receiving in her knee. She had bad knees and she was receiving injections, so she would be uninsurable. Anytime a client is receiving injections or any type of treatment for knees, hips, arms, any type of treatment, they're not going to be insurable at that time. So Jack went ahead and applied on his own, and he was approved at Class 1 rates due to spinal stenosis. So even though Jack had the spinal stenosis, they still would consider him, or they still offered him a policy at Class 1 rates. And when I say Class 1 rates, Class 1 with Mutual of Omaha and Transamerica, that's the third underwriting class. So premiums are at 25% higher than standard rates. So the good news is Jack did get approved, annual premium $2,777. Well, in 2018, Diane was ready to apply. She came back to us. She told us that she'd had knee replacements in 2016, 2017. So that's great. So the insurance companies will now consider, after clients have knee replacements, if they're fully recovered 6 months after the replacements, physical therapy is all done, then they may be insurable. Insurance companies would consider them. But when we took her application, we realized she had no more osteoarthritis in the knees because of the knee replacements, but she was having sciatica pain with injections. She had some diverticulitis, and her height and weight was not great. You know, it was okay, but she was a little bit heavy. So I was a little afraid with all these three combinations, she may not be insurable. But I contacted underwriters and they said, well, maybe. So go ahead and submit the application. So then they had to decide, should Jack apply again with Diane? Because remember, they wanted that shared care. And of course, everybody wants to get the couple's discount. Well, Jack's current premium is that $2,777. If Susan applies on her own, her annual premium $5,131. Okay, so Jack would keep his own policy, Susan apply on her own. That's what, so Susan's premium $5,131. But if they apply together, they can get that shared care rider they wanted initially, because in order to get the shared care rider, you have to apply at the same time, and they could get the 30% couples discount. So they decided to apply together, and their combined premium $7,672. And Diane was insurable. I think, I'm sorry, apologize. I just realized here that we had her name is Susan, but her name we had named her was Diane. So again, this is Jack and Diane. So Jack and Diane's combined premium, if Jack applies again with Susan, they would get that discount, $70,672. Save them $236, and they have shared care rider. So not a huge savings, but they have that shared care rider and they did save some money. Let's talk about short-term care. I see I'm running out of time. Short-term care is a policy that we've heard about recently. We started selling about 2 years ago. I call this Plan B. As the name implies, it's for short-term care. It's not for long periods of care, but it does provide nursing home care, assisted living, and home health care. Issue age is 50 to 89. Simplified underwriting, so clients that may not qualify for traditional long-term care may qualify for this. And unisex pricing, so it's good for women. Nursing home benefits on these policies, $10 to $300 a day, you have a choice. Elimination period, 0 up to 100 days. Benefit period, 90 days to 360. And you can use the benefit twice in your lifetime. So if you go on claim and use the year, then go off claim and down the road, get sick again, you can use it all over again. The bad part is there's no inflation riders on these short-term care policies. You do have to have a hospital indemnity on the policy. It's required. So there's indemnity, $10 to $300 a day. Begins first day of hospital stay, lifetime max 365 days. So this means if clients in the hospital, they would receive the regular health benefits through their health insurance, but also this hospital indemnity on top of that. And you can add a home health care rider onto the policy because most people want to receive care in their home. In order to qualify for benefits under the rider, it must receive care 3 days of the week for at least 1 hour. Benefits amounts $150 to $1,200 weekly. Benefit periods 13 weeks to 52 weeks. Who is a good candidate for one of these short-term care policies? Those clients that want a less expensive option. Maybe they've been declined for traditional long-term care. As I said, the underwriting is easier on this. Older clients up to their 80s, they could apply. So woohoo, she's happy. If your clients have a net worth less than $500,000, that's kind of our rule of thumb at LLIS. If your clients have liquid assets of less than $500,000, premiums on traditional long-term care policies may be hard for them to handle. So this may be a good option for them, the short-term care. And a good option for females because, again, those unisex rates. So here's Sandy. I just wanted to give you an idea what the premiums for one of these short-term care policies would be. For Sandy, we did a $250 daily benefit using the 80% rule for care here in Clearwater, 100-day elimination, 360-day benefit period. I went with the smallest hospital indemnity benefit and the highest home health care benefit, $1,200 a week for 52 weeks. Annual premium on this policy is $790. So a good, decent policy, no inflation rider, and not as good as a long-term care policy, but I think still a good option for clients. So what I did here is I'm comparing a short-term care policy to a long-term care policy for Sandy. Can't get the benefits exactly the same, but pretty close. $250 for each for nursing home and assisted living. $1,252 weeks for home health care with short-term care. $250 for home health care with long-term care. 52-week benefit period, used twice in your lifetime. 2-year benefit period, 100-day, 90-day. No inflation, didn't add inflation for either, just to sort of keep it apples to apples. Here's the difference in premiums. The short-term care is about half price. So again, a good option, not all the bells and whistles as a long-term care policy, but I still think a good plan B for those clients that can't qualify or don't want the high premiums for long-term care. I'm going to finish up by talking about some hot topics in long-term care. So in underwriting for long-term care, most of the companies nowadays, if your clients have been declined in the past for long-term care, it's hard to get approved on a new policy. We work with 3 companies, Transamerica, MassMutual. If your clients have been declined in the past, they can no longer apply with those companies. Mutual of Omaha may consider them. If we email Mutual of Omaha and tell them the situation, why they were declined, then they may consider them for coverage. If both parents have been diagnosed with a cognitive issue, client will be uninsurable with Mutual of Omaha. If both parents have a cognitive issue, I think there's about a 70% chance that the son or daughter will also have a cognitive issue. If one parent has a cognitive issue, then Mutual of Omaha would limit the benefits to $5,000 a month. I have not seen Transamerica or MassMutual go this way yet, but usually a lot of companies follow suit, so I wouldn't be surprised if the other companies go that way. Another big deal with Mutual of Omaha is they now accept use of marijuana if it's 3 times or less per week. Then this is recreational marijuana use, not medical marijuana. If there's any medical marijuana, then Mutual of Omaha, no, they will not consider them. Transamerica and MassMutual still will not accept any marijuana use at all. Mutual of Omaha will also now accept the use of CBD oil. 2 years ago they wouldn't, but now they would. I think CBD has become one of the biggest rages in this type of care. You see the CBD advertised all the time now for a range of different things to help people sleep, to help with pain. I'm also even seeing it for dogs. They offer it for dogs and their anxiety. So CBD is now acceptable with Mutual of Omaha. That ends the webinar, but I just wanted to let you all know that a registration is now open for our LLIS Insurance Academy. This is our annual academy. It's starts on Wednesday evening with a meet and greet, and then Thursday and Friday, 2 days of insurance education, and you receive continuing education for this, and we have it February on the beach in Clearwater. So think about it, all you that are up north now starting to get cold, how nice would it be to be on the beach in Clearwater, having lunch on the beach in Clearwater in February, and also receive some good education. And here's some of Mark Mauer's wonderful corny jokes. Top 10 things that make LLIS different are free webinars that you're listening to today. Next one coming up in December, I believe it's being done by Mark. He's going to talk about insurance planning for the new year. There are some other things that makes LLIS different. We're not your competition. We're not trying to get your clients. You are our clients. You fee-only advisors. We take time to pre-underwrite to avoid surprises. We proudly sponsor these different organizations. Hope to see some of you at the upcoming ACP conference in San Diego this month. We proudly sponsor all these. Here's some other reasons. We have our advanced premium emails, our notes. And we also have Alice now, our 24/7, 365 days of the year portal where you can check on your clients' policies and see what they have in force or see what they're working on. So I'm going to try to answer some of these questions that I see have come up. One question is, how would diabetes affect the client's chance of qualifying for long-term care? If your client has type 2 diabetes and it's under the control, A1C is under control, there's no other symptoms that are out of control, yes, they would qualify for long-term care. If it's type 1 diabetes and they use less than 50 units of insulin per day, and they've been diagnosed, it's not been 20 or more years since they were diagnosed, then a Mutual of Omaha would consider them for coverage. Again, everything would have to be under control. So it depends on the type of diabetes and how it's under control. Question is, if a client has autoimmune disease, are they uninsurable? Again, it depends on the type of autoimmune they have. Many times with autoimmune, they are uninsurable, but we really would have to get more details, how long ago they were diagnosed, what medications they take, and how sort of different aspects of it. But it is hard to get coverage, but it may be possible. Okay, so a lot of different questions here. What is the youngest age that a person should consider long-term care insurance? I would say mid to late 40s. It's okay to start considering it. Most people don't start to consider it until their 50s. In their 40s, it's good to lock in a policy when the rates are less and they're in good health. I haven't done it recently, but I ran a couple times testing. Are you better off to pay premiums for lock policy in at younger rates and pay premiums for a longer period of time than wait and pay a higher premium for a shorter period of time? It still works out better to lock it in while you're younger and pay over a period of time. Okay. The question is, are there any situations where it makes sense to self-insure? Yes, there are situations where it makes sense to self-insure. Our rule of thumb, I mentioned the 500,000 or less clients, it may be hard for them to afford the premiums for long-term care. So kind of our rule of thumb, if your clients have liquid assets between 500,000 and 3 million, they may be good candidates for long-term care policies. Those ones that have 2 million to 3 million or higher, they could self-insure, but maybe a hybrid policy would be a good choice for them. The hybrid policy, they would have immediate pool of benefits ready for them, so that if they went on claim at any time, they would have it. And by having the pool of assets, they're saving their own assets for their children or for their beneficiaries by having the hybrid policy or having a long-term care policy. Even if they could self-insure, maybe they want to choose not to because they'd rather use the insurance company's money to pay for their care than using those assets that they saved many years to build up. Okay, I think I've covered most of these. Oh, I have a question here. Where can you see the LTC rates by each state? As I mentioned, the Genworth cost of care study that they do every year, you can find that on the internet. So again, it's Genworth cost of care study, and that lists the rates for care in all the different states. It lists it by home health care, assisted living, and nursing homes, private and semi-private. So that is a great source. Or give me a call or send me an email. I'd be happy to find out cost of care in your client's area. Question is, so did Tom's hybrid policy effectively cost $200K as a lump sum? Yes, that $200K lump sum that we used from Tom's cash value from his old policy was a single premium, and that's all he needed to fund it. So he's got a paid up policy. He doesn't have to worry about sending any more checks in or paying any more premiums. Okay, is the couples discount available from all companies or only one specific company? No, all the companies offer a couples discount. So if both couples apply, it's depending on the company, 25% or 30%. Most of the companies, if we have a single person apply and she has a spouse or partner living in the home with them, even if that spouse or partner do not apply, the spouse that is applying would receive a 15% discount because they have somebody living in the home with them. Because the thought is, if you have somebody in the home with you, you're probably not as apt to go on claim quickly as you would if somebody's living on their own. Okay, I think I need to stop now. It's 5 o'clock. Thank you all for joining us. Any questions that I missed, we will record them and I will send you an email with the answers. So if you want, go ahead. Probably too late now, but any questions that I haven't gotten, I will get to you with an email. Or if you didn't have time to write in a question, please send me an email or give me a call and I'll be happy to answer you. Thank you very much for attending. Take care.